Hello, you're welcome to this lecture. Still on Unit 3, Accounting for Property, Plant and Equipment, IAS 16. We'll be looking at Section 5, and Section 5 is on Guidance on Depreciation of PPE. Guidance on Depreciation of PPE. We've looked at what depreciation is under Section 1, where we define some of the key terms under property, plant, and equipment. At the end of this session, you should be able to account for depreciation in the financial statement, explain the annual reviews that are required, and how these reviews are reflected in the financial statement. And 3, explain the accounting treatment of reversal of impairment and disposal of an asset. So these are what you should target yourself to understand and produce at the end of this lecture. Guidance on depreciation of PPE. The depreciation amount of an asset shall be allocated on a systematic basis over its useful life. So when you want to get a depreciation amount, you spread it over the useful life of the asset. The depreciation method used shall reflect the pattern in which the asset's future economic benefit are expected to be consumed by the entity. So we have the depreciation method, and the method is going to reflect the pattern in which the asset's future economic benefit are expected to be consumed by the entity. Now, the depreciation charge for the period shall be recognized in profit or loss unless it is included in the carrying amount of another asset. So the depreciation charge now is a profit or loss item. It's an expense, so you send it to profit or loss unless that depreciation charge is included in the carrying value of another asset. Land and building are separable assets and are accounted for separately, even when they are acquired together. One thing you need to understand is that land is a non-depreciable asset. However, buildings are depreciable assets. So anytime in the question, land and building were given to you together, you need to separate them and depreciate the building. So the question will give you the land component or the building component. If one component is given to you, just subtract it from the total amount of the land and building and then use the other for the working. The emphasis is on the building because you are looking for the building amount to depreciate. The land, you don't depreciate it. Now, if the cost of land includes the cost of site dismantlement, removal, and restoration, that portion of the land asset is depreciated over the period of benefit obtained by incurring those costs. So we are looking at other components. If there has to be what? The cost of what? The site dismantlement. You have to dismantle the site, you have to remove and removal and restoration. That portion of the land has to be what? Depreciated. So the question will break it down for you. Then you depreciate it over the period of benefit obtained by incurring those particular costs. Okay. Now let's look at the review of the useful life we define what the useful life is under section 1. So the review of the useful life of an asset, or the useful life of an asset, can be reviewed. So you are basically saying that the residual value and the useful life of an asset shall be reviewed at least at each financial year end. And if expectations differ from previous estimates, the changes shall be accounted for as a change in an accounting estimate in accordance with IAS 8 accounting policies, change in accounting estimates and errors. So if there is a need for you to review the useful life, and if that happens, you have to account for this change in accordance with IAS 8 accounting policies, change in accounting estimates and errors. Now let's take an example. Question 2 under the self-assessment question. Question 2 under self-assessment question. An asset was purchased for 100,000 cedis on 1st January 2015, and straight line depreciation of 20,000 per annum is being charged, basically telling us that the asset has a 5-year life with no residual value. The annual review of asset lives is undertaken, and for this particular asset, the remaining useful life as at 1st January 2017 is 8 years. The financial statements for the year ended 31st December 2017 are being prepared. So if you are preparing the financial statement for 31st December 2017, how much are you going to charge as depreciation, since the useful life of the asset is changing now? So they say, what is the depreciation charge for the year ended 31st December 2017? Now let's analyze the question. You bought the asset on 1st January 2015 for 100,000, and they say you are going to use the straight line method of depreciation, of which you are going to charge depreciation of 20,000 per annum. So if you charge depreciation for 5 years, the 100,000 will be exhausted. So the useful life is 5 years. However, they have reviewed the asset, and as at 1st January 2017, it's now having a useful life of 8 years. So 1st January 2015 to 31st December 2015 is 1 year. Then from 1st January 2016 to 31st December 2016 is 2 years. So they have actually charged 2 years depreciation. So the carrying value of the asset as at 1st January 2017 would be 100,000 minus the accumulated depreciation of 40,000 for these 2 years, which you'll be getting 60,000. However, ideally it's supposed to be left with 3 years for this asset, but now they say the useful life is now 8 years. So right from 1st January or in the year 2017, you are no more going to use the 5 years, but rather the 8 years on the carrying value of the asset. So now the carrying value is 60,000. So from 2017 or 1st January, you apply 8 years. So it's going to be the 60,000 left over 8 years, and that will be the annual depreciation to be charged using the straight line method for the remaining 8 years. So you would observe that the depreciation figure is going to change. So this is what we are saying. The 100,000, then you take out a 2 years depreciation, which is 40,000. So 2 times 20,000. Then you'll be left with a carrying value of 60,000 as at 1st January 2017. To get the annual depreciation for 2017, it is the carrying amount divided by the reviewed useful life of the asset now, which is 8 years. So henceforth, the entity will be charging a depreciation of 7,500 for the next 8 years. This is how we treat the review of the useful life. If the carrying amount is changing or the useful life is changing, you have to know what is changing and how to go about it. So here, the useful life is changing. So we use the reviewed useful life. Assuming the value of the asset is also changing now, there has been a revaluation, but the useful life did not change, then the focus would be on the revalued amount. Alright. So more examples are in the book. Try your hands on it. Now we want to look at the review of depreciation method. The method we use for calculating depreciation. It can also be reviewed. Now the depreciation method applied to an asset shall be reviewed at least at each financial year end, and if there has been a significant change in the expected pattern of consumption of the future economic benefit embodied in the asset, the method shall be changed to reflect the changed pattern, and as such a change shall be accounted for as a change in an accounting estimate in accordance with IAS 8. So we are looking for a review in the depreciation method. Is it that you are using the straight line method? You are using the reducing balance method? You are using some of the years digit? You are using the sinking fund method? You have a lot of method for calculating depreciation, and if you are changing this, it will result in what? A change in the estimate. So your depreciation amount is going to change, and we say you account for this under IAS 8, accounting for change in accounting estimate. So this become a change in estimate as a result of what? You changing the depreciation method. We're going to look at impairment of asset values. Impairment of asset values. We define impairment loss in our previous session. Now, impairment loss should be treated the same way a revaluation decrease should be treated. The loss should be recognized as an expense, and it should be charged directly against any related revaluation surplus to the extent that does not exceed the amount in the revaluation surplus account in respect to the same asset. So if there is impairment loss and then you have revalued that asset which is having a revaluation surplus, you use the impairment loss against it to the extent that it can absorb. If it can absorb, the excess amount goes to profit or loss account. And we say reversal of impairment loss should be the same or should have the same way as revaluation increase. So if you are reversing the loss, it should have the same treatment as how you treat revaluation increase. So if you are having a revaluation increase now, ideally it has to come to OCI. But if there is any loss recognized in the previous year, you have to send that gain to the extent that the loss can be recovered in the profit or loss account. So that is how you treat impairment of asset. Now let's come to derecognition. You want to derecognize the asset in your books. So the carrying amount of an item of property, plant, and equipment shall be derecognized, shall be removed from the books. A, on disposal. So when you sell the asset, you do no longer own it. So you have to what? Remove it from your book. You have to derecognize it from your book. Or when no future economic benefit are expected to flow from its use or disposal. So when we were defining what PPE is, that we were looking at the recognition criteria, we said that it has to be able to generate future economic benefit. So if you are here and then the asset can no more generate any future economic benefit from you using it, then you have to what? Derecognize it from your books. Now, the gain or losses arising from the derecognition of an item of PPE shall be included in profit or loss when the item is derecognized. So any gain or loss associated with that derecognition is sent to profit or loss. Remember, the gain that you are recognizing here shall not be classified as revenue. They shall not be classified as revenue. You get revenue from your core operations of the business. You are not into the business of disposing assets thereabout. So if there is any gain as a result of the derecognition, you don't classify it as what? Revenue. You send it as a gain, a separate line item to the income statement. Okay, so that is all about this session as well. We'll look at the review of the useful life of an asset. We look at the depreciation method. We solve an examples on depreciation as well. So we also look at the guidance on depreciation and try as much as possible to solve more examples as we have in the model for you to aid your understanding. So we meet in the next lecture, which is the last session for Unit 3. Stay safe. Thank you.